you can see how I have individual components of the net income, and it essentially corresponds to the, we'll take every line and back out the cash component from it. In the indirect method, we simply back out the non-cash component of the total net income. So this is just a more refined disclosure, if you will, right? It just basically, it's rather than just adjust the whole number, it adjusts individual component, but the answer will still be the same. Now, why is that important? Because potentially the direct method statement of cash flows provide more information to the users of financial statements. Because you don't want to, you just don't, because when you just look at the total number, it doesn't give you the same level of disaggregation. So I want to have a sense of what it's like. And so that's why I wanted to, you know, to share that with you. Okay, so for net income, for example, for sales, the corresponding line for the cash flow statement will be cash collection from customers, right? So how much cash of those sales was actually collected from customers? Now, obviously, the cash collected from customers may be from sales from prior period, from current period, and from current period, right? So it's going to be kind of shifting cash collected in time, right? So how do we know how much cash was collected from customers? So the easiest way to do this is to analyze the accounts receivable T account. So I'm going to say accounts receivable here, right? And I'm going to analyze how much cash was collected from customers. And the beginning balance in accounts receivable was 50,000. Now the ending balance was 400. I'm sorry, it was 450,000. So the beginning was 400,000. We'll change. Okay. Right. I also note sales for the year were 3 million. Now I will assume, for the sake of this calculation, that they were all entirely on credit, and that's fine. And because even if they were for cash, we'll assume that it was on credit, which immediately was collected. So 3 million, right? So, so how much obviously was collected in those during that time? Well, what was collected? What were the accounts receivable collections? And obviously I got it wrong because receivables is a debit account. It should be here. Right? What were the collections? Well, the collections were whatever the credit was, right? So the credit is 4 plus 3 minus 450. So my collections were 22,950,000. So cash collected from customers was that number. Now, note that what is that 2,950 equal to? I could have gotten it another way. I could have simply taken 3 million and subtracted what? Subtracted $50,000 increase in accounts receivable, right? Note that when we were in the indirect statement of cash flows, we in fact subtracted the increase in accounts receivable from when they calculated CFO. That's wise, because if accounts receivable go up over time, it reduces the amount of cash collected, right? And you can see that happening very vividly here. Now, what was the corresponding part of cash cost of goods sold? The cost of goods sold, the corresponding element is cash paid to suppliers. So now which account should I analyze for that? What I need to analyze for that is an inventory account and accounts payable account, because if you think about how the the way this works is inventory gets bought on credit first, we're going to assume, and then and that generates purchases. Those purchases are then paid off through accounts payable. That's how we're going to assume that. So I'm going to put inventory here. Now, what was my inventory? Well, my beginning inventory was 750. My ending inventory was 770. My cost of goods sold was, right, my credit to cost of goods sold was in fact 1.4. It needs to be as a positive number because it's a credit. Well, now I need to balance this account out. I need a debit here. That will be my purchases, right? So what is that? That's 770 plus 1.4 minus 750, 1.420, right? And that makes sense because think about it, my inventory actually went up over time, so it must buy $20,000. So it must have been that purchases exceeded my inventory taken out by 20,000. So that makes sense. Now that, we assume, but this is not necessarily purchasable for cash because we have accounts on which we are paid, and which we run our cash from, right? So what I'm going to do, I'm going to create an accounts payable account here. And these purchases will throw through there, right? So accounts payable beginning balance was, we know, 300. Ending balance was 340. I'm going to assume that that this 1.4 million was entirely on account, right? And then the payment would be the debit here, right here. What was that debit? Well, that was 300 plus 1.42 minus 340, this 1,380,000. So this is in fact cash paid to suppliers for the inventory. So I can put that as a minus here. Okay. Right now, I can, meanwhile, I should be checking off the accounts I've analyzed, right? So which accounts I have analyzed? I analyzed sales and cost of goods sold. I also analyzed accounts receivable. I analyzed inventory. I analyzed accounts payable. And that's it. So far. Then there was other operating costs. So I'm going to get there 1 second. First of all, note that the next line of income statement, so we go line by line of the income statement. Next line of the income statement is depreciation expense. What do we do with it? We ignore it. Because it's a non-cash item, so it doesn't make it onto the cash flow statement. Now, what was the equivalent of quote unquote and ignoring it in the indirect method? We added it back to net income because we wanted to undo its effect. So simply right now, I can check off and we'll do nothing about it. So I have this other operating expenses. That's what will pertain to basically things like sale and general administrative expenses, cash paid for other operating costs. And what is the corresponding account on the balance sheet? It will be accrued expenses, right? Things like that's what it goes through. So I'm going to create an accrued expenses T account. Accrued expenses T account. So my beginning balance in that account is 50, ending is 45. And I'm going to assume that, first all of these other operating expenses were on account. We need to make it positive, right? And some of it was actually paid off, right? In terms of cash, that would be this debit. So that's 955,000, right? And notice that it's 950 plus the change. So 955. And I can mark off this one. And finally, I have here, what's next line. So I check off this line item. Gain on sale of investments. Again, it doesn't even know that investments are taken care of where? In the investing section. Here, when we do the investing section, we'll simply add that gain to proceeds, right? We'll put it as part of the proceeds. Here, we can ignore it because it's not an operating item. Now, what did we do on the in the indirect method? Because we didn't want to double count it, it was already included in net income. It had to be taken out of net income. To undo it, to ignore it, meant subtracting it on the CFF when you do indirect method. Now, under the direct method, you can simply skip it. That's the same equivalent of that, just like you can skip depreciation. Right? So finally, the last line item is, in fact, cash paid for taxes, because we have income tax expense here. Now, we don't have an income tax payable account, so we can assume, because there is no income tax payable as a liability, that all of that was paid in cash. So we can simply just add that 145,000, right? And that should give me my CFF, my CFO, which is 490,000.